Hey there, welcome to my live stream. I'm Mitch Goldberg, host of Be the Boss of Your Money. It's a live stream all about personal finance and investing, the stock market, the economy, so that you could take control of your money. That's why we call it Be the Boss of Your Money. Today's big topics: ARK Investor Fund, ARKK, down about 30% from its high. That is a shellacking by anybody's standard. What else we're going to talk about? Dogecoin above 50 cents. I mean, this is like the most speculative thing that I've ever seen, and it's up over 50 cents. 50 cents per coin might not sound like a lot, but coming from where it was, it's a pretty huge gain. Couple more things that we need to talk about. We need to talk more about the Pfizer vaccine ready for approval for adolescents age 12 to 15 years old. We need to talk about inflation and some very big time strong comments from Janet Yellen stating the obvious. We've got inflation and it might become a problem if we don't take care of it. So that's what this show is all about. If you have any questions, whether if you're watching in the live stream or in a replay, hit me up in the comments about what we're talking about now or anything about money, personal finance, investing. I love to hear from you. It's the best part of this whole show. And now we are going to roll a quick intro and we're going to jump into the content. Here we go. Thank you so much for joining me. I'm Mitch Goldberg. You're watching my live stream called Be the Boss of Your Money. It's all about personal finance, taking control of your money. Because if you don't take control of your money, then your money is going to take control of you. And that's very easy to happen. So we've got a number of very big, important topics to go over today. I want to first talk about what we usually do here. Quick review of the day, of the market, tell you what's going on in the world of economics. We get into the heart of the matter, which is ARK Invest. Now, if you're not familiar with ARK, ARKK, stick around. This has been a super hot fund. It's a really super hot topic with the Robinhood Army, hashtag Robinhood Army. And it's just a very big topic with the younger set. And if you don't know about it, you really should know what's going on because it speaks volumes about what I see as some of the cracks developing in the foundation of the stock market. So there's some worrisome signs. So first, we're going to go to the share screen. I'll put myself up over here in the corner. Hey, I'm over here in the corner. I'll make the screen a little bigger so you could see it and follow along. And if you're just listening to the show, well, that's okay because I'm going to talk about this and you'll just be able to listen to it. If you're out there, you have questions, you know where to find me. Got a couple hellos out there. I see the diamond hands out there. All right, I'm going to bring you guys up in a moment. In fact, let me do it now. First of all, I know my friend Josh is out there. Thank you. And while you're watching this, hey, don't hesitate to give it a thumbs up or some kind of reaction, maybe a heart. And this way I get to see who's out there, which is always a lot of fun. Hey, Jonathan, great to see you, buddy. And I love your content, your videos. And if you, by the way, when you're watching this, go follow Jonathan Bednar on LinkedIn. He knows what he's doing. He's got some incredible, just incredible content, very eye-opening, very easy to understand, but hard-hitting. Great communicator. And this is where we get the diamond hands. It's so funny. Like, this was so not the financial advisor lingo. And now it's like we've all adopted it, made it our own, So yeah, diamond hands, paper hands. Hodl's kind of old already. Stonks, right? Meme stocks. Okay, so let's take a quick look. The Dow eked out a little tiny gain of about 20 points, barely up. And that's good because it was one of the only things that were up. Why did the Dow go up today? I'll tell you why, because Dow was up 2.5%. Caterpillar was up. Johnson & Johnson, JP Morgan, United Health Travelers. See some financials, Verizon, Honeywell. We had a couple of bigger winners than losers in the Dow Jones of 30 stocks. The losers in the Dow, I'll just scroll down, where Apple was the big one. Salesforce was like $230 plus a couple of days ago. Microsoft giving some back. Apple down. Cisco. McDonald's is down. Ooh, I could go for a vanilla shake from McDonald's. Drinking my Dunkin' iced coffee right now. It's almost done. I don't know. I love iced coffee. So let's go back to what we're looking at. The NASDAQ. This is like the main story of the day. NASDAQ gets cracked down 261 points, down almost 2%. That definitely is attention getting. And the S&P was pulled down by these large cap tech stocks, down 0.67%. Gold backed off a little bit. Oil continues on its run, speaking to what people are talking about with this inflationary bump that we're getting. Lumber, copper, oil, lots of things, plastics, resins, they're all going up in price. Packaging, cups, everything going up in price. And the VIX was up 6%. That's typical for the VIX to be up 6%. It's a very volatile indicator. The VIX, volatility index, the fear gauge, it means that when it goes up, professional investors are paying up for portfolio protection, for hedging. They're hedging their portfolios. It's because they're worried about the market going down, and that's why you see it going up. So with the VIX, you want to see the VIX go down. That's the one thing that you want to see go down. So the fact that it's up is not a good thing. It's actually it's a bad thing. Okay. So let's take a look at a couple of other things here. It's not Dogecoin, by the way. It's just pronounced Dogecoin, I found out. Surges 30% to a record above 50 cents as speculative crypto trading continues. I mean, Ether is up a lot. Also, rise of the Ethereum, blockchain. This is the international sign language for riding the blockchain. Okay. All right. So crypto is moving up. Bitcoin is the one that's really taking it on the chin because Ethereum is getting all the attention. But Dogecoin, this to me is as speculative as you get. And, Mark Cuban and Elon Musk have talked it up, which, look, it annoys me from this perspective. Okay, not that anyone really gives a crap about what I'm going to say, right? But I know as a financial advisor, I have responsibilities, and I really can't get on to a live stream and tout a crypto and recommend a crypto and recommend a stock. I can talk about the good and the bad. You make the decision, and you're welcome to call me for my personal opinion via phone or email. That's fine. But to a live broadcast, I don't tout these things, these coins or whatever, because the people listening, I don't necessarily know your risk tolerance, your level of investing experience. I don't even know if you know about this stuff. So for me to come out here and say, oh yeah, you got to buy this, you got to buy that. Oh, this is going to go crazy. Somebody might actually act on that and buy it because of what I said without me getting to know them. The whole point of being a financial advisor is you're supposed to take the time to get to know someone, their risk tolerance, their time horizon, their experience, their level of sophistication, education, things like that. And it doesn't have to be formal education, just their experience in life, right? And you're supposed to know these things before you recommend something to a client. And that's fine by me. I'm all about education. Okay. So Dogecoin moving up. And now let's talk about some of the more important stories, because Dogecoin is still a Dogecoin is a tempest in a teapot. Okay. But this is big. Treasury Secretary Yellen, he used to be the chairman of the Federal Reserve before President Trump replaced her with Jerome Powell, who's still the chairman of the Federal Reserve. And we expect him to remain chairman of the Federal Reserve because we expect Biden to nominate him to continue his chairmanship of the Fed. Okay. But Yellen says rates may have to rise somewhat to keep economy from overheating. I think that cat is out of the bag. The horse is out of the barn. You get my drift here, baby? Okay. Did I just call you baby? I don't know. I'm sorry about that. It'll never happen again. I will never call you baby again. Sorry. Okay. So Yellen says, Yellen is a very serious person to listen to. She's one of the one of the key policymakers for Biden's tax plans, proposals, Secretary of the Treasury, and she was a highly experienced central banker. Even before she became chairman of the Fed, she was vice chair under under Ben Bernanke. So when she says rates have to rise somewhat, well, basically what they're saying is we've got tools if inflation gets out of the way. So let me sum up everything to you with regards to all of this. Hey, John is out there, by the way. Thank you very much, John, for joining me. And I see a few others I'm going to point out in a wee little bit. I see the comment by the dip. Very funny. I'm going to put all that out there. Okay. And I'm going to answer your questions, which I love. I hope you stump me. I just hope you stump the heck out of me with your questions. Okay. Gives me a reason to go look up something, learn a little bit more, get back to you with the answer you need to make a decision. Here's the thing about inflation. This is the most important thing that you're going to have to know that explains the whole ball of wax with inflation. Here it is. Jerome Powell, chairman of the Federal Reserve, who is in charge, the Federal Reserve, the FOMC, the Federal Open Market Committee of the Federal Reserve, is in charge of interest rate policy. Chairman Powell sees any bump up in inflation that we get now and over the near term as transitory, meaning temporary. And his whole argument is that, look, before the pandemic, we had 3.5% unemployment and steady growth for years. And we still had very little inflation. Interest rates were still very low. Not just short-term rates at the Fed held at or near zero, but even longer-term market rates for the 10-year Treasury and the 30-year Treasury. So to him, it's like, well, after this initial bump up and we get back to full employment and faster economic activity or steady economic activity, we'll probably go back to baseline low inflation where we've been for the last 30 years. I know 30 years ago, inflation was higher. 40 years ago, inflation was higher. But if you look at a long-term chart, the trend has been consistently down until the last couple of months. Okay. We've had a few periodic bumps up in inflation over the last 10 years or so. Sporadic. They never hold up. So that's his thing. It's like, well, I see it as transitory no matter what, because we're just going to get back to baseline with low unemployment. What the inflation hawks are saying is, no, what we see is because of $5 trillion of extra federal spending, all that money pumped into the economy, and a rebound in the economy, which means there's an inventory shortage of everything from semiconductor chips to food to plastics to metals, lumber, you name it. We don't think the inflation is transitory. We think it's going to last a while. We don't think the economy goes back down to baseline. We'll probably hit 10% plus GDP for the quarter we're in now, according to Goldman Sachs. And we're going to stay strong throughout the rest of this year and into next year. That's not so transitory. And we don't know how long it's going to take for inflation to go back down. In the meantime, the Federal Reserve is buying $120 billion worth of bonds, $80 billion in treasuries, $40 billion in mortgage backs every month. Lower, interest rates are still zero bound. Not the 10-year. I'm talking the rates that the Federal Reserve holds. And we've got tons and tons of stimulus hitting the economy. So we think the economy is going to heat up. So who's right? Who's wrong? The market is starting to tell you that the market's right, investors are right, and Powell with the Federal Reserve is wrong. And if you take a look at how this is going to work, will the Fed blink and say, you know what? Maybe it's not so transitory. we blink and we're going to raise rates. And when that happens, investors could be shell shocked without adequate warning, and that would just plunge everything from the stock market to the bond market, you name it. And investors globally will freak out, and we'll have a I don't want to say a nuclear winter for the stock market. That's a little too much hyperbole, but it'll be a really bad shock to the system. So that's what everybody's worried about. And we just don't know. So that's the whole thing on inflation. Okay. So let's keep going. So that was Treasury Secretary. I could get rid of that one. All right. Let's take a look at this. COVID-19. FDA to authorize the Pfizer vaccine for adolescents by early next week. Now, for a little market research, my wife actually spoke to our pediatrician, okay, because my youngest is 15, and our pediatrician says she would be shocked, floored, if the approval didn't come out next week for adolescents. So that's even more people back to school, more people with summer jobs, more of everything. The economy is booming, and this just adds fuel to a good fire. Okay. So that's something important to go by. Florida has opened, fully opened. Good for you, Florida. And other states are following. So even New York is starting to open up, which is great. And I'm really excited about it. About time. So there you go. Okay. And a couple of other things. So we took a look at some of the Dow stocks already, and then we're not going to get into that yet. Let's just take a quick look here. And then we're going to get into, I'm talking to you. I don't want to necessarily put up my screen every time I say something, because I don't want to bore you to death. So we're going to talk about this. I'm going to take the comments and look at who's here. We've got the best part coming up, which is ARK Invest. Okay. But the losers of the day, obviously technology. When you see the NASDAQ get smacked the way it did today, technology is the loser of the day. Consumer discretionary, communications, real estate. It was just a negative day, but energy and industrials and financials are up today. I know healthcare was up today too, but energy, that's XLE, XLI, XLF. These are the big ETFs that track these particular sectors. If you look at that, at what's up, this speaks to rotating out of tech, out of work from home, stay at home stocks into reopening stocks. So that was the theme of the day. And if you look at some of the industrial stocks that I cover, Granger, I mean, this has been such a bull, but up another almost 3%. United Rentals, Caterpillar, Northrop Grumman, John Deere, Honeywell, UPS. These are as economically sensitive as you get, and these stocks all had really good days. Some of the COVID-related stocks, like BioNTech, was down 15%. That's the Pfizer partner for their COVID vaccine. Novavax down. Let's take a look at some of the stocks that we cover here on Be the Boss of Your Money as examples. Corona list. All right. Teladoc is down. I want to show you something. You see this red line here? It's a little green. So Teladoc has gone from $308 to $158. So the stock is basically cut in half. All right. Zoom has been more than cut in half. All right. 588. Well, almost cut in half to 304. But look at how much these stocks are down from highs. Activision, 104 to 88. And Activision's been touted as a stock with pricing power, and it should hold up well. You can't fight this flood of money coming out of work from home, stay at home into industrials and, back reopening stocks. Domino's is holding up like a champ. Peloton from 171 to 96. That is one hell of a cut. And I was talking about Clorox when it was in the 200s, and I said, you've got to look out for that. That is a perfect stock to get slammed by higher prices of inflation, higher input costs. Plus, all of a sudden, people maybe don't feel like they need as much Clorox wipes because we're getting back to life and we're getting vaccinated. 240 to 182. That's like a $24 stock going to 18. That's a nasty dip. So my takeaway from these stocks that have gotten hit is this. Money is coming out of the second tier tech stocks. And it's going into the large tech stocks, which even though they're down today, Apple, the FANG M stocks, that's Facebook, Amazon, Apple, Netflix, Google, and Microsoft. So when those stocks go up, the averages look really good. So you don't see the deterioration that's happening with the second tier stocks because the first tier stocks are the beneficiary of that. But I think the cracking of the lower part of the foundation, if you will, the second tier stocks, I think that's a warning of what's to come, because a bull market is marked by aggressive trading and investing. And a lot of these aggressive stocks, like Zoom, I'm not saying the company's aggressive. It's a great service, but the stock has gone up so much and come down so much, Peloton, et cetera, that the bigger stocks are next in line. And this could be the start of that. And I think that's the indication of a correction, in my opinion, in the horizon. Now, it's easy to say a correction's in the horizon, and that's not a call on my part, really. I'm just saying this for you, my compliance people, are going to watch this tomorrow morning and say, look, a correction can happen at any time for reasons that we don't even understand until some time passes. But I see deterioration, and I'm concerned about it, that eventually that money stops coming out of these stocks because there's nothing left, which means the bigger stocks can't hold up anymore. So this happened in the year 2000. In March of 2000, January, February, March of 2000, the stock market was crumbling, but you didn't see it, you didn't know about it until March, when the NASDAQ, S&P, and Dow finally rolled over. So if I tell you now with the S&P 500 just off its all-time high that the market's deteriorating, you'd be like, the market's barely down, Mitch. What are you talking about? But if you look beneath the surface, there's so much deterioration. And a bull market is marked by the more aggressive stocks going up, not down. And then you finally have some money going into the most speculative investments, the most speculative things, okay, like Dogecoin. So you put all those together, in my mind at least, it paints not a great picture. Could be wrong. And this is, that's just my opinion, in my opinion, okay? So I want to take a look at who's out there. Then we're going to get into the ARK fund, okay? So we've got Jonathan. Thanks for the shout out, my friend. You're welcome. Hi, Mark. Good to see you, buddy. Try decaf iced coffee, baby. I've had so much coffee. My teeth are chattering. I've had so much coffee today. Way too much caffeine. I'm actually drinking water to hope that, washes out some of the caffeine. But you're right. I really need to go to decaf. And we've got Brandon. There it is. There it is. Buy the dip. Buy the dip. Did you like the post I had yesterday on Instagram? By the way, folks, I'm on Instagram at InstaMitchG, and I post stuff on Instagram that I do not post on LinkedIn or Facebook. So go over there, follow me there. I'm on LinkedIn. Connect with me there. Nice to see you, Brandon. Thank you so much for joining me. And here we are, John Tutt. Before I answer your big question, I just want to say, hey, Phil, how are you? Can't wait to visit you. So nice of you to join us. Really appreciate you. Love you, buddy. Thank you. And now we're going to get to John's question. Okay. Hey, Mitch, with ARK and the NASDAQ tanking today and the more to come, is this another way for us novice investors to ride out, or should one be cutting their losses and running for the hills? I am inclined to think the former and just ride it out. Your thoughts? And I'm not your baby. Hey, if anybody's my baby, it's you, Cupcake. So inappropriate for a live stream. Just kidding. We're going to get together, I think, right? June 9th, you said, John? We're getting together, the crew, right? The high school crew. And if you're watching this, well, you are watching this. Why would I say if you're watching this? John and I have been friends since kindergarten. That's a long time. That is almost 50 years ago. Wow. And we're still in touch and friends. That blows my mind how lucky we are. Okay. So to answer the question, which is the best question of the day before we get into the ARK fund, which is going to be the best thing we're going to do today, second best thing, your question's the best thing. Make it a matter of make it a matter of your personal finance. This stuff, the ARK fund, for example, is aggressive. And that's okay, because that's, being aggressive is where you have the highest upside potential, as opposed to being conservative, which could be more stable, but less upside potential. My feeling is, if you have a stock, any stock, you pick a stock, at 20 and it goes to 300, I would be inclined to take some off. Maybe not the whole thing, but definitely take some off. That's one. Number two, if this is a significant amount of your invested assets into this aggressive stuff, I would take some off, because personal finance dictates that as you get older, you have less time to make up for losses. And unless we have another, pandemic-induced shutdown, I don't see how these sky-high stocks that have all come down, I don't see how they go back to where they were. That's me. I don't see how they get back to where they were. Now, there are a few diamonds in the rough that could get back to where they were. And there's a few analysts who are coming out with buy recommendations in some of these stocks, which keep going lower. But the situation is this: if you're not part of the rotation, you're part of the past. So that's my view. Okay, so you have to look at your personal finance. And now, if this money you have is tied up in these stocks is a small amount for you, and you could ride it out, and it's not going to affect your ability to retire, or if you've planned on using all those profits for something, then you have to scale out or get out. I'm not saying you have to leave the market, but I think some of these stocks have gotten so damn high that no matter how long your time horizon is, they're not coming back. AOL is never coming back to what it was. Yahoo is never coming back to what it was. Lucent is never coming back to what it was. Okay. And these were the winners of the year 2000. There was eSpire, there was RSL Communications, there was GST Communications, there was Global Crossing, if you recall. Did these stocks ever come back? Long-term holders just are sitting on worthless paper. Okay. So now let's talk about the ARK fund, and I'm going to give you my opinion first. The ARK fund is it a really good fund with a magical fund manager, Kathy Wood? By the way, this is not another video product to bash the heck out of ARK and Kathy Wood. I don't know her, and I just want to get that straight. This is a question of, is she really the soothsayer or the technologist, the seer of things that we can't see yet? Does she have this special vision for gains for the future? Or is she just another fund manager? Or is she just another fund manager riding the work from home, stay at home hot stock trend? I think it's the latter. She could disagree. You could disagree. But I'm going to show you what's in the stocks or in the fund. So let's go to the tape, okay? This is the ARK fund, ARKK. And just to give you an idea of how it's doing year to date, give it a second. Let me make the screen a little smaller, because I'm not going to be able to pull up the quote. I can make it larger, but stock closed at 113. It's down about 9% year to date versus the NASDAQ, which I would say is its best, benchmark. NASDAQ is Not doing so hot this year either. But year to date, the NASDAQ is up 5.78%. So we'll be generous to call it 6%. Okay. But the ARK was beating the pants off of everybody. Okay. So let's see what the deal is and why. All right. ARK Holdings is Tesla, almost 10%. Teladoc, which is a stock we just looked at, which has been absolutely crushed. Square, Roku, Zillow, Zoom, which has been absolutely crushed. Shopify, Baidu, Exact Sciences. So these top 10 stocks make up almost 50% of the stock. I'm on ETF.com, by the way. So you could go check this out yourself. All right. But the reason I say second tier stocks are doing so badly and you don't really see it, okay, is because most of these second tier stocks like Teladoc and Zoom, they're not in the S&P 500. Tesla is, but that's just one stock. But the bigger companies like Google, Microsoft, Facebook, Apple, they've been holding up pretty good, with the exception of today, but they've been holding up really well. So in my opinion, ARK is not a new movement or a new epiphany kind of situation. It's not a paradigm. That's the word I'm looking for. I don't think it's a new paradigm. I just think it's just another fund that rode the hottest tech stocks. And now that they're going down, the fund is going down with them. I don't like when fund managers become celebrities, because over time, it's proven over time, most fund managers, like 99.9% of them, eventually underperform their benchmark. And studies have shown that when they do outperform, there's a lot of luck involved, and the outperformance is only very brief. So I don't like when somebody becomes a superstar in an area where consistency is almost impossible to achieve. That's the way I see it. I greatly appreciate you taking the time to watch this live stream, and I'll be back tomorrow. And it's 32 minutes. I can't believe how fast it went. I really enjoyed this, and I greatly appreciate you taking the time to watch. Your time is valuable, and it just means a lot to me. I'm on YouTube. You can check me out, Client First Strategy. I'm on LinkedIn, Mitchell Goldberg, Instagram at InstaMitchG, and Twitter at Mitch_Goldberg. And I'll see you tomorrow. Thank you.